Okay, look, I'm just going to say it. It is February 19th, 2026.
Right.
And if you're brave enough to open your crypto portfolio app right now,
Yeah.
well, you are significantly braver than I am. I looked this morning and I physically recoiled.
It's genuinely ugly out there. We're not going to sugarcoat it.
Ugly is a very polite way to put it.
Yeah.
We are sitting in what looks like a 45, maybe 50% drawdown from the highs we saw late last year.
Yeah.
Bitcoin has essentially been chopped in half. Inflation is acting up again, which, by the way, nobody seemed to predict would happen this stubbornly. So the central banks are being weirdly unpredictable.
And the SEC.
And the SEC.
Yeah.
They seem to be on a total warpath this year.
It really is the perfect storm for investor anxiety. You have the price action crushing your spirit, and then you have the macro environment just crushing your hope.
Honestly, I have this distinct urge to do one of two things. Option A, sell everything, delete the apps, throw my phone in the ocean, and go live in a cave until 2030. Or option B, and this is a dangerous one, panic buy everything because it's cheap, and I have the sixth sense of FOMO that I'm missing the bottom.
That is the classic fight or flight response. I mean, in financial terms, you're torn between capitulation, just giving up, and reckless gambling.
Yes.
And usually when you feel that pull between two extremes, you're about to make a mistake.
Exactly. I feel like I'm walking a tightrope in a hurricane. But we are not going to panic today. We're going to fix this.
Yeah.
We have a stack of research here, specifically the Hive 5 Dispatch Byte Edition, and their take is, well, it's not what I expected.
Oh.
They claim we're looking at this crash all wrong.
Right. They're arguing that this isn't about picking the right token to save you. It's not about finding the one coin that goes up while everything else goes down. It's about installing an operating system.
An operating system.
Wow.
Like Windows or Mac OS, but for my money.
Think of it that way. Most people treat their investments like a collection of, random apps or lottery tickets. Oh, I like this dog coin, or I heard this tech is good. This source argues you need to treat your portfolio like a business with distinct functioning departments. They break it down into 5 specific blocks: core, innovation, yield, flow, and seed.
And the kicker is, apparently, most of us, myself included, are building these blocks in completely the wrong order.
Completely backwards. And in a market like 2026, a backward portfolio gets wiped out. I mean, when the tide goes out, you see who built their house on sand.
Okay, so here's the mission for this deep dive. We are going to unpack this operating system. I'm going to play the role of the investor who wants to make money now, because let's be honest, who doesn't?
Of course.
And I want you to walk me through why this framework suggests I should probably slow down and rebuild from the ground up.
Deal. We're going to look at the risk ladder, the flow routes, and something called the Shield Protocol. But we have to start with that aha moment you mentioned, the mistake everyone is making right now.
Let's get into it. Why is my portfolio backwards? I feel like I bought good stuff.
Think about how you usually get into a new crypto investment, especially during that run-up we had in 2025. What's the first thing you looked for? Be honest.
Usually, the gains. I see a token pumping, or I see a yield like an APY of 20 or 30%. I think, I need that.
Exactly.
I want the thing that moves fast.
You start with yield or speculative innovation. You throw money at the riskiest stuff because it's exciting and it triggers that dopamine hit. Then maybe you buy some Bitcoin. That's your core, almost as an afterthought. And you only think about safety, the seed block, when the SEC comes knocking or an exchange freezes your funds.
That feels like a personal attack, but you're not wrong. I definitely worry about the password after I've bought the coin.
The Hive 5 framework insists you have to flip that stack. In this environment, February 2026, you cannot survive if you don't start with seed.
Seed. It sounds agricultural, but I'm assuming we aren't talking about farming.
Seed is the foundation. It's custody. It's censorship resistance. It's all the boring stuff that keeps you alive. And the reason we start here is the regulatory environment. The data shows that back in 2024, the SEC hit the industry with a record $8.2 billion in financial remedies.
$8.2 billion. That's a staggering number.
It was a record year. Over half of that came just from the Terraform Labs case. But the trend hasn't stopped. It accelerated into 2025 and now 2026. The source classifies regulatory risk right now as an amber zone.
Amber zone implies a caution light. A slow down and look around signal.
It does. The danger isn't just that the price of your token goes down. The danger is counterparty risk.
Yeah.
It's the platform you're using getting sued, shut down, or freezing assets. If you're building a house, you don't start with the penthouse disco. You start with the concrete foundation. If the foundation cracks, the disco falls down.
Okay, I get the logic.
Yeah.
But playing devil's advocate here, self-custody is a massive hassle. I have to buy a hardware wallet, write down seed phrases on metal, hide them in my sock drawer. I want to be able to trade fast. If the market dumps, I want to click sell on an exchange, not fumble with a device. Can't I just skip seed for the sake of speed?
In a bull market, maybe you get away with it. In this market, no. That's where the Shield Protocol comes in.
Shield Protocol. Sounds like something out of a Marvel movie. Is Nick Fury involved?
Unfortunately, no. It's essentially a mandatory safety checklist. For the seed block, the Shield Protocol demands verification of cold storage and recovery procedures. It's not just about what you hold, it's where you hold it. The source puts it bluntly. If you have paper Bitcoin on an exchange that gets hit with an enforcement action, you don't have Bitcoin, you have a claim in bankruptcy court.
That is a sobering thought. I'd rather have the keys than the court date.
Precisely. And the Shield isn't just have a wallet, it's have you tested your recovery? If you lost the device today, could you restore it? If the answer is no, you failed the Shield Protocol.
Okay, survival first. I've got my keys, I've tested my recovery, I'm safe. Now, can I buy the dip? Bitcoin is down nearly 50%. It feels like a bear market. Is this cycle over?
This brings us to the core block. This is your Bitcoin and your Ethereum. And this is where the debate gets interesting. You look at the chart and see a crash.
Yeah.
The data in the Hive 5 dispatch sees post-peak consolidation.
Post-peak consolidation sounds like a fancy way of saying we lost a lot of money and we're trying to feel better about it.
It feels that way emotionally. But look at the structure. We're oscillating. The price is rejecting those deeper lows. It's staying in a band. The source calls this the lime zone on the risk ladder.
Lime zone, that sounds sour. Or is it like a margarita?
Think of it as early ripening. It signals a stabilizing structure. The forced sellers, the people who are over-leveraged, the people who borrowed money to buy at the top, are exhausted. They've already sold because they had to.
So if the sellers are done, we moon now.
Not necessarily. This is an accumulation corridor. It's boring. It's choppy. It's designed to frustrate you. It's designed to make you lose interest. And the specific flow route for core right now is labeled exit and defense.
Wait, exit? I thought you said we're accumulating. Why would the route be exit?
Exit and defense, regarding other positions to feed the core. You're pruning the weak stuff to buy the conviction assets. The goal here is primary wealth accumulation, not short-term flips. You are exiting the noise to defend the signal.
See, that's the hard part. My instinct, and I think most people's instinct, is to wait until the news is good. I want to wait until CNN or whoever says Bitcoin is back before I buy. I want confirmation.
And that is exactly how you miss the asymmetric entry. If you wait for universally bullish news, you are buying the top of the band. You have to buy when it feels boring. When your friends stop asking you about crypto, that is the lime zone.
Right.
That is the discipline.
It's so counterintuitive. We want excitement, but the system demands boredom.
Precisely. If it feels safe, you're late. If it feels boring and slightly uncomfortable, you're probably on time. Now, let's talk about the fuel for this system. You mentioned earlier you wanted to buy everything, but what are you buying with?
Well, cash or stablecoins.
This is the SL block. And in 2026, this is maybe the most misunderstood part of the portfolio.
Because cash is trash, right? That's the old saying. Inflation is elevated again. If I'm sitting in stablecoins, I'm losing purchasing power every single month. Why would I hold a depreciating asset?
That's the FOMO talking again. Let's look at the macro picture. Inflation surprises are happening. Central banks are uncertain. They might raise rates. They might cut. Nobody knows. This makes crypto act like a high beta asset.
Can you define high beta for us? I hear that term thrown around, but what does it actually mean for my wallet?
Sure. It means it moves like tech stocks on steroids. When macro anxiety hits like a bad CPI print or a war rumor, investors get scared. They sell the risky stuff first. So crypto correlates with stocks and just drops hard.
Okay.
So the FLOW block isn't just sitting on the sidelines, it is operational liquidity.
Okay, so how much FLOW should I have?
The source suggests that in this orange zone, risk environment, orange meaning high macro uncertainty, you need significant reserves. We're talking maybe 20% of the portfolio.
20% in cash. That feels huge. That's a fifth of my portfolio doing nothing.
It's not doing nothing. FLOW is an offensive position. It is your dry powder. When we get a macro flush, say, an inflation report comes in hot and Bitcoin wicks down 10% in an hour, That is when FLOW activates.
So I'm not hoarding cash because I'm scared. I'm hoarding it so I can be the shark when everyone else is bleeding.
Exactly. Think of it like oxygen tanks for a diver. You don't carry them because you plan to drown. You carry them so you can stay underwater longer than anyone else. The Shield Protocol for FLOW is about capital flexibility. If you are fully invested 100% in tokens and the market tanks, you are paralyzed. You might even be a forced seller to cover living expenses. FLW ensures you are never forced to sell. You are only ever a forced buyer at the bottom.
Okay, I like being the shark. I can get on board with that. Let's move to the exciting stuff, the innovation block. The source talks a lot about Ethereum here, specifically something called Fusaka and PDAS.
Right. This is the tech catalyst. We're looking at the green zone here, fundamentally. The tech is working.
Okay, green zone means go. But tell me about this PDAS. It sounds like a German beer brand. I'll have a pint of PDAS, please.
It actually stands for Peer Data Availability Sampling, and it's a massive deal for Layer 2s on Ethereum.
Give it to me in plain English. Why should I care about data sampling? Is this just nerd talk, or does it make money?
It makes the network usable. Okay, imagine a library. Before PeerDAS, every time a new book or a block of data came in, every single librarian or node had to read the entire book cover to cover to verify it was real and complete.
That sounds incredibly inefficient. They'd never get anything done.
Exactly. It's heavy, it's slow, and it limits how many books you can handle. PeerDAS allows the librarians to just check a few random pages samples to mathematically prove the book is complete. They don't have to download the whole thing.
So instead of reading the whole book, they just check page 4, page 92, and page 200 to make sure the book exists.
Roughly, yes. And if enough librarians check enough random pages, the whole book is verified. Because of that, the bandwidth and storage needs drop dramatically. The result: an order of magnitude increase in data capacity for Layer 2s, cheaper fees, higher throughput. It's the infrastructure for mass scale.
Okay, this is where I get excited. Tech upgrade equals number go up.
Yep.
So the strategy is to buy ETH and all the L2 tokens, Optimism, Arbitrum, Base, and Get Rich. Right.
And here is the trap.
There's always a trap. Why can't it just be simple?
The flow route here is take profit.
Well, you just said it's a green zone. It's a massive upgrade. The librarians are efficient. Why am I taking profit?
Because infrastructure catalysts often get priced in before the usage explodes. Everyone knows Fusaka's coming. It's public knowledge. The price pumps on the rumor. By the time the upgrade is live, the asymmetry is gone.
Buy the rumor, sell the news.
It's more nuanced than that. You design partial exit rules around the catalyst. You don't hold blindly through the hype. You trim the position as it goes up into the upgrade. You capture the value that the speculation created.
So don't fall in love with the tech. Use the tech news to feed the core.
Exactly. You recycle those gains back into the boring stuff. You let the innovation block work for the core block.
Okay, speaking of gains, let's talk about the block that got everyone in trouble in the first place. Yield.
The yield block. The siren song of crypto.
The source talks about BTCFi, Bitcoin finance. Finally, I can earn a yield on my Bitcoin. Protocols like Babylon are mentioned. This feels like the holy grail. I have Bitcoin. I want more Bitcoin, so I stake it. Free money, all right.
There is no such thing as free money. This is the amber zone again.
Why? If it's Bitcoin, isn't it safe? Bitcoin doesn't break.
The asset is Bitcoin. The vehicle is a smart contract. When you move Bitcoin into a staking protocol or a liquid staking solution, you are introducing smart contract risk.
Yeah.
You're taking the safest asset in the world bearer asset, Bitcoin, and wrapping it in code that might have a bug.
Right. If the code breaks, my Bitcoin is gone.
Or if the bridge gets hacked. Or if the liquid token depegs. The yields are attractive, that's why we're here, and Babylon is fascinating tech, but the Shield Protocol rules for yield are strict.
What are the rules? How do I do this without getting wrecked?
Process over price. First, you must check the lockup schedules. Can you get your money out when you want? Second, you must audit the custodian models. Who actually holds the keys? The key insight from the source is this. The edge in yield isn't being first. It's being the earliest disciplined capital.
Meaning, I shouldn't ape into a protocol on day one just because it offers 1,000% APY.
Never. You let the other guys be the crash test dummies. You enter when the audit is done and the TVL, the total value locked, is stable. And the flow route...
Let me guess. Take profit.
Take profit.
You really hate compounding, don't you?
I love compounding, but I hate ruin. If the yield drops or if the reward token gets diluted, you rotate out. You don't marry the farm. You farm the crop, you sell the crop, you go back to seed or core. You treat it like a business transaction, not a lifestyle.
Okay, I'm starting to see the picture here. It's not just a list of coins, it's a machine.
It's an operating system. Let's try to visualize the whole map. You have these 5 blocks: seed, core, flow, innovation, yield. They aren't silos, they're interlocking gears.
So let's play a scenario. Let's say tomorrow inflation spikes to 5%. Markets panic. How does the machine react?
Great test. Okay, inflation spikes. The risk ladder flashes orange.
Yeah.
No panic. The system reacts first. Flow expands. You might sell some speculative innovation assets, maybe those L2 tokens that are getting hammered, to boost your cash reserves, preserving your dry powder. You stop the bleeding in the risky assets.
Okay, so I'm cutting the risky stuff to get liquid.
Yeah.
What about my Bitcoin?
Core holds steady. It's your conviction. You don't sell your core on a macro flush. You rely on the shield you built in seed to keep it safe. You ignore the price action on Bitcoin because you know it's the lime zone accumulation phase.
And yield.
Yield tightens. If volatility is high, smart contract risk goes up. You might pull capital from lower tier farms, the risky stuff, and move it back to safety. You reduce your surface area for problems.
So it breathes. The portfolio contracts into safety when things are bad and expands into risk when things are good.
Exactly. It moves from a bag of random trades to a structured organism. You are no longer reacting to headlines. You are executing pre-planned logic. You sleep better at night because the decisions were made before the stress hit.
That is a massive mental shift. I think for me, the biggest takeaway is realizing how backwards I've been. I've been chasing the yield to get rich, hoping the innovation saves me, and ignoring the seed.
And that works until it doesn't. In 2026, with this macro pressure, you can't afford to be backwards. If you're backwards now, the market will correct you and it will be expensive.
So if you're listening to this and feeling that portfolio anxiety, that tightrope feeling, here's your to-do list straight from the High Five Dispatch.
Step 1, seed. Fix your custody. Don't get wrecked by the SEC or a platform insolvency. If you don't hold the keys, you don't hold the block. Verify your recovery today.
Step 2, core. Define what you actually believe in BTC, ETH, and recognize we're in the lime zone. It's boring accumulation time. Don't wait for the fireworks to buy. Embrace the boredom.
Step 3, Flow W. Build that cash pile. It's your ammo for the volatility that is definitely coming. 20% might feel like a lot, but you'll thank yourself when the next flush happens.
And finally, step 4, innovation and yield. Allocate the remainder here. Play the Fusaka upgrade, farm the BTCFi yields, but do it with strict take-profit rules. Do not fall in love with the narrative.
That's the framework. It's simple, but it requires discipline. And discipline is scarce in a bull market, but it's essential in a chopped market like this.
Here's a final thought for everyone to chew on as we wrap up. We talk a lot about making it in crypto, but in a world of 2026 macro pressure, maybe the investors who survive aren't the ones with the best stock picks or the ones who found the 100x gem.
No. They're the ones who treat their portfolio like a business with an operating manual.
So ask yourself, are you trading narratives or are you running a system?
Because narratives change. Systems survive.
That's it for this deep dive. Go check your seed block, people. We'll catch you next time.
Stay safe out there.